Hello, welcome back to part 3 and our wrap up of chapter 11 and a discussion of retirement plans. Here we're talking about the concept of annuities. Now, we use the term annuities when talking about pension plans or retirement plans, how much is distributed to the beneficiary over time. But in this section, we're being a little more specific in that we're talking about annuities that are not part of an IRA or a 401k or other type of retirement plans. So these annuities are a contract. Often an individual will put a lump sum of money into an account with the idea that that account will pay them a set amount per month for so many years or for the rest of their life, whichever. That's referred to as an annuity. It wasn't necessarily through a 401k or an IRA scenario. It is what is referred to as a non-qualified annuity. But they are fairly common, especially when an individual receives a lump sum amount, say that an inheritance from their parents or something upon death, rather than blowing it all at once. They may put it in an annuity and have it then stream of payments to make sure that they have income for the rest of their life or for a set period of time. So the annuity is a series of payments pursuant to this contract. Typically, some of the payment is taxable and some is tax-free. All right, so the tax-free part is what you put into the annuity, the amount. So, for instance, as we learned way back early on, if you inherit money from your parents, that's not taxable income. So if you take that money and put it into a plan or into a contract where you give them that lump sum and they agree to pay you so much per month for the rest of your life, okay, the amount you put in is the cost of the annuity, all right? And that is the amount you should get back without paying tax on it, right? Because all you're doing is getting back what you put in. So that's the cost. And then what you get out is the expected return, okay? The total amount that we anticipate receiving. So some annuities are going to pay you out a certain amount per month for a set amount of time, a specified amount of time. So the expected return is how much you're going to get for 10 years, how much you're going to get for 15 years. So if it tells you you're going to get $600 per month for 10 years, the expected return is just $600 times 12, because you're going to get it every month for a year, times 10. That's your expected return. If the contract is going to provide payment for life, then we have a little different scenario. Now we have to estimate how long they're going to live to see the expected return, to determine the length of time. And that will be from the tables they're provided with your textbook that are provided to calculate this, okay? Typically, that amount will be from table 5 in your textbook, okay? And so you're going to then say, okay, here's how old they are when they started receiving money from this annuity. And so if they're going to expect it for the rest of their life, you look at the table, you see their age, you see how long they're expected to live, and it says 20, and that's going to pay us $1,000 a month, then the expected return is going to be $1,000 per month times 12 times 20, the expected life. And once you've done that, that is locked in. So you're going to, that's going to calculate the percentage. So you're going to take the cost of the annuity, how much you put in, divided by the expected return, and that amount is not going to be taxable. That percentage or ratio is not going to be taxed on each payment until you reach the expected life. So You make the calculation once, get that percentage, and it applies to every payment you receive until you reach the end of your life expectancy. So if you did it at 65 and your life expectancy was 20 years, from the table, and I'm not going to look up the table, but say that was the amount. Then when you get to year 20, after year 20, all of it is income because you have received back all of the amount that we expected to get back, all of the cost. All right? So in year 21, any payment you get from that annuity, because remember the contract is to pay it for your life regardless of how you live. So some people are going to live shorter period of time and some people are going to live longer. Well, if you happen to be one of those people who are longer, from a tax standpoint, you're going to get income in that year 21. So to check our salary annuity is a series of payments under a contract, always the same amount each period. Typically they are, but they could be different. Okay? And they usually have a taxable component and a non-taxable component. Remember, you're getting back what you paid in after tax as part of, you don't have to include that in taxable income. And the extra that you're getting is interest that is earned, that will be taxable income. All right. Once you've calculated your percentage, that is your exclusion ratio. That gets applied to every payment in the annuity up until you reach either, if it's a 10-year specified number of payments, then your annuity's over and those are the easy ones. If it's a life annuity and you are expected to live 19.4 years, when you get past 19.4 years, anything after that is going to be income.